Something big just happened, and it could shift the balance of global technology. Trump's team has pulled the plug on TSMC's waiver, the deal that let it ship US chipmaking tools to China without restrictions. Starting this December, every shipment will need government approval. Samsung and SK Hynix are now under the same rule. The fallout won't stay in Asia. Supply chains in Taiwan, South Korea, and Europe will slow under new costs and delays. While Washington drowns its allies in paperwork, China's chipmakers like SMIC are pressing ahead, and Beijing is racing forward in artificial intelligence. And as this chip war escalates, another crisis is unfolding. US Treasuries are plunging. The 30-year yield has surged back near 5%, sending bond prices down and pushing up costs on mortgages, business loans, and government debt. Investors worldwide are selling, alarmed by record deficits, shaky policies, and even court rulings that could erase billions in tariff revenue. What's really breaking is trust. US bonds, once the safest investment, now require ever higher returns to attract buyers. Pension funds and central banks are stepping back. Political fights are undermining the Fed's independence while Washington keeps spending. Put these stories together and the picture is dark. America squeezing allies, China gaining ground, and US finances under strain. And it reaches straight into your life. Your savings, your job, your future. Stay with me. In this video, I'll show what's happening, why it matters, and why the months ahead could be far more dangerous than most expect. Subscribe, turn on notifications, and let's dive in. Let's begin with what happened just last week. Washington scrapped TSMC's special waiver, the arrangement that allowed the company to freely ship American chipmaking equipment to its plant in Nanjing, China. Starting December 31st, every shipment will need a separate US license. And TSMC isn't the only one affected. Samsung and SK Hynix have been pulled into the same system. What used to be smooth, predictable trade is now a maze of applications and waiting periods. The slowdown doesn't just hit China, it drags down America's closest partners too. This comes at a time when China is accelerating its work in artificial intelligence. Companies like DeepSeek are already rolling out autonomous AI agents capable of competing with OpenAI. Their pace is visible in real results. Yet instead of targeting Beijing directly, Washington has tangled its allies in the fight. Factories in China that were operating normally now face the prospect of long delays. Not because of Chinese rules, but because shipments are sitting in American paperwork queues. Take TSMC's Nanjing plant as an example. On paper, it may only contribute a modest share of overall revenue. But the real risk isn't the size of its balance sheet. If licenses get held up, production can grind to a halt. Samsung and SK Hynix face the same uncertainty. Their challenge is no longer whether they can produce chips, but whether the essential tools will even reach them. That leaves these companies trapped between two difficult options: comply fully with Washington's orders or risk losing control of their supply chains. And this is where the frustration grows. While TSMC and Samsung are left waiting, American firms like Nvidia continue to do business in China. They keep generating revenue while their foreign partners take the losses. The message to allies is hard to miss. What is presented as national security begins to look more like a push to redirect investment and manufacturing back to US soil, even if it leaves friendly nations squeezed. But there's a hidden danger in this approach. By blocking partners from serving the Chinese market, Washington could be fueling exactly the outcome it wants to avoid. Domestic firms like SMIC and HuaHong will be forced to scale up faster, fill the gaps, and capture more market share. Instead of slowing China down, this policy risks accelerating its self-sufficiency. Once Beijing reaches that stage, there may be no way to reverse it. This isn't just about tough rhetoric. It's a step that could fracture global supply chains, deepen the strain on allies, and open wider opportunities for China's technology sector. The White House frames it as a move to protect security, but the result may hand Beijing the leverage it has been chasing for years. Now let's look at where Washington wants this fight to go next. After squeezing its allies in Asia, the Trump administration is pushing hard to bring chipmaking back onto American soil. The centerpiece of this plan is Arizona. TSMC has pledged up to $165 billion in investment there, spread across 6 sites covering advanced fabrication, packaging, and research. To support it, Washington is offering $6.6 billion in direct grants and another $5 billion in loans through the CHIPS and Science Act. On paper, it looks like the perfect fix. Bring the crown jewel of global chipmaking closer to home. But look beyond the headlines, and the scale of the challenge stands out. In the second quarter of 2025, TSMC controlled just over 70% of the global foundry market. Out of every $10 spent worldwide on contract chip manufacturing, 7 went straight to TSMC. These aren't just ordinary chips. TSMC builds the processors that drive artificial intelligence, power smartphones, run cloud servers, and keep high-performance computing alive. So when Washington asks TSMC to replicate that capacity in Arizona, it's not asking for a minor relocation. It's asking the company to rebuild the beating heart of global technology from scratch. And Arizona is already showing how difficult that will be. Fab 21 was meant to push into 4 nanometer, 3 nanometer, and eventually 2 nanometer production, among the most advanced nodes in existence. To make them work, you need not just buildings and machines, but a highly trained workforce. Estimates say the US will need hundreds of thousands of new specialists to support the fabs being built. Yet those skills are in short supply. Delays have already forced TSMC to fly in Taiwanese engineers to train American staff, sparking political friction and local resentment. The project has already missed its 2024 timeline, and the problems won't vanish quickly. Trump's vision of a fast turnaround collides with the hard reality of building the world's most advanced technology ecosystem from the ground up. Meanwhile, China is moving in the opposite direction. Companies like SMIC and HuaHong are steadily expanding at home. Beijing has spent years preparing for a breakdown in global supply chains, investing heavily to ensure it can survive on its own. That groundwork is paying off. Ironically, the US may now face more risk than China if chip flows are disrupted. Washington remains deeply reliant on imports, while Beijing has steadily cut its dependence on outside suppliers. While Washington wrestles with chip factories and supply chains, the battle over artificial intelligence is accelerating at an even faster pace. For the United States, this isn't just another tech rivalry. It's about protecting the very tools that shape economic power and military strength in the 21st century. Chips provide the hardware foundation, but the other half of this equation is software. And at the center of it are large language models, now essential for everything from scientific research to defense planning. For the moment, OpenAI's ChatGPT still holds the global benchmark. Its systems are stable, widely trusted, and deeply embedded across industries. But in recent months, China's DeepSeek has been closing the distance at a pace few imagined. By early 2025, officials in Washington were already warning that America's edge had narrowed from years to only a handful of months. The concern goes beyond technology. Despite billions of dollars poured into US startups, the business model has proven fragile. Roughly 95% of American AI companies are shutting down within months of launch, burning through funding without finding stability. Meanwhile, China's progress is visible in hard results. DeepSeek's R1 and V3 models, built with around 2,000 Nvidia GPUs and only a single-digit million-dollar budget, have reached performance benchmarks in reasoning and coding that match, and in some cases surpass, the latest versions of ChatGPT. The efficiency is striking, producing results that rival a company backed by billions, with only a fraction of the resources. That momentum has already translated into public adoption. In January, DeepSeek's app surged to the top of the US App Store, overtaking ChatGPT as the most downloaded free app. It wasn't just a symbolic victory. It showed how quickly Chinese platforms could win market share, even in America's home arena. The surge has shaken confidence in Washington. Leaders at OpenAI have openly cautioned that DeepSeek's lower costs could rewrite the global AI landscape. If American models are seen as heavy, expensive, and slow to adapt, While Chinese rivals deliver cheaper and faster alternatives, the balance of influence in this field could tilt far sooner than expected. As the race for artificial intelligence accelerates, one company finds itself caught in the middle: Nvidia. Its graphics processors are the backbone of modern AI, powering both OpenAI's ChatGPT and China's DeepSeek. These chips are the engines that allow massive language models to scale and advanced systems to function. Without Nvidia's hardware, the breakthroughs we're seeing in AI would stall. That's why every new policy out of Washington ends up directly on the desk of Jensen Huang, Nvidia's founder and CEO. For Huang, the stakes couldn't be higher. He has repeatedly described China's AI market as a $50 billion opportunity, not just a profitable segment, but the foundation of Nvidia's long-term growth. Losing access to that market, he warns, would reach far beyond the company's balance sheet. It could mean tens of thousands of jobs lost, a slowdown in American innovation, and a weakening of U.S. influence in one of the most important technological races of the century. But those ambitions now sit on unstable ground. Trump's shifting restrictions, sometimes tightening, sometimes easing, have turned China into a geopolitical minefield for Nvidia. One wrong step could cut the company off from its fastest-growing customers. At the same time, Washington's pressure has fueled suspicion abroad that U.S. policy is designed not only to slow China, but also to control where global companies can make money. For Nvidia, that uncertainty is dangerous. It must navigate between protecting its business and avoiding the appearance of defying its own government. And while technology firms struggle with these shifting rules, America is facing another kind of strain, this time at the core of its own financial system. The U.S. bond market is flashing red. Long-term Treasuries, once seen as the safest asset in the world, are under heavy pressure. The sell-off has intensified, pushing yields to levels not seen in decades. The 30-year Treasury has climbed above 5% again, a threshold touched only briefly back in July. That isn't just a number on a chart. It means Washington has to pay far more to borrow, and the higher costs ripple outward into mortgages, corporate loans, and even household credit card debt. And it's not only an American problem. In Japan, long-dated government bonds touched 3.3%, the highest ever recorded. In Britain, the 30-year gilt surged to 5.7%, a level last seen in 1998. Together, these moves show that the stress is global. Investors are watching closely because higher borrowing costs hit government budgets directly. The US, Britain, France, and Japan are already weighed down with enormous debt. In the past, pension funds and major institutions would buy these long-term bonds and keep markets stable. Now, many of those buyers are retreating or demanding sharply higher yields before they're willing to lend. That shrinking appetite is pushing borrowing costs even higher, turning what was once the safest corner of finance into one of the most volatile. The pressure has only grown after a federal appeals court ruled that most of Trump's tariffs were illegal. It may sound technical, but the financial consequences are massive. Governments that counted on steady tariff revenue now face the prospect of refunds. Billions that were considered secure income could suddenly vanish, tearing fresh holes in national budgets. For bondholders, it's yet another reason to question whether governments can control their deficits. The timing couldn't be worse, and the ruling has injected new uncertainty into markets already on edge. There was a brief moment of relief when weaker U.S. job opening data hinted at a cooling economy, nudging yields lower. But that calm didn't last. The broader picture shows investors abandoning long-dated government debt, once considered untouchable, and moving into alternatives. One of those alternatives is gold. Spot prices have surged to new highs, reflecting a deep loss of trust. For many investors, gold is now seen as a safer store of value than bonds themselves. This crisis in the bond market is only beginning, and the consequences could reach into every corner of the economy. From savings and pensions to borrowing costs and currencies, the impact will be wide and painful. Stay with us, because in the next video, we'll dig into what this shift means for your money and how quickly the fallout could spread. Make sure you subscribe so you don't miss it.